Oh, good afternoon. This is Steve Hill, CEO of AIQ Systems. Welcome to this session where we're going to be discussing the market action in June, both the pullback and also the subsequent bounce from there and where we are. As usual, we'll start with the Dow Jones Industrial Average combined with the New York Stock Exchange breadth data that is used by the market timing system. Over 400 rules are involved in establishing where the market is. The reason this system works this way is that it looks for divergences between the Dow itself and the breadth data off of the entire New York Stock Exchange. So that includes a whole bunch of different stocks, both all the tech stocks and everybody else out there. So it's an interesting, valid system for looking for divergences, trend changes that might not be reflected in just price itself. So let's get right down to it. If I click my ER button here from the left-hand side, it takes me back to the most recent rating, which was in June the 5th. There was one 2 days before that, June the 3rd. So a 99 down, and then 2 days later, another one. This one was a 98 down. We use the price phase indicator as our primary confirmation of an expert rating if it doesn't change direction. There is some philosophy that says it should be going in the direction already of a rating. I want the change in direction really for it to be the most valid. And in this case, we did have a change in direction from going up to going down. And it has to happen within a couple of days of the rating itself. Otherwise, we consider the rating not valid. And we are working on the process to incorporate some of this confirmation into a rating itself. So that may be coming later this summer, and we'll keep you posted on that. So right now, that rating was pretty good just before the pullback on the Dow itself. And of course, also at the same time, if I bring up the spider by the side here, we'll use the spider as a surrogate for the S&P 500 index. And at the same point here, a very similar point, the date here, we had 6.3, 6.2. You can see the same sort of a situation occurring. There was a pretty good pullback from about the 760 level all the way to the 723 level. If you look at how big that is, it's not huge in the grand scheme of things, but it was a pretty good move to be signaled by the rating. So that was a great rating. As we said, phase was confirming that. The indicators that led this rating to fire at this time well, mostly I look at the high-low indicator, remember number of new highs versus number of new lows off of the New York Stock Exchange. And I look at the advanced decline indicator, which is a combination of advances and decline in volume. So it measures how the internals of the advancing issues versus declining issues are performing on the New York Stock Exchange. So both of these on the New York Stock Exchange. And you can clearly see prior to this June double sell signal here, the signs were in place. We already had a divergence on the internals. The advances and decliners were going, basically decliners are outperforming advances. And new highs and new lows, the number of stocks making new highs was declining, even though the Dow and, of course, the S&P will continue to climb higher. So there was signs of the internal opposites, the divergences, that, some weakness was going on in the market. So that was a great, a good signal at that point. Obviously, there was a rally here. There was no expert rating because this was what I call a real big whipsaw. Because the system looks for longer term indicators over a period of 21, 50 days, all the different standard indicator dynamics. This was a real rapid switch around from a big down day and then a big up day. And we both, we all know why, the macroeconomics that drive that. And that's often difficult for the technical analysis that we use, and that most of us chartists use, to be able to make some sense of that. So in this case, there was no expert rating, though there was a change up in the phase. But and then since that time, the advanced decline indicator and the new high, new lows have kind of moved in sync with the price action of the Dow. So that's where we are in June. Excuse me. We're back right now. We're at this point here. This is downloaded all the way through to the 23rd. And the market's heading up into a new high zone again. So what's happened in the spider? Let's have a quick look here and see what's going on. We all know that the S&P 500 has been going very strongly since the late March. A very, very powerful move to the upside. Part of the dynamics, as I've talked about in prior sessions, is the Magnificent Seven, as they're called, the massive portion of the S&P's total value that is wrapped up in seven stocks: NVIDIA, Apple, Microsoft, Amazon, Google, Alphabet, Facebook, Meta, and Tesla. Now, those seven together, because the S&P 500 index is capitalized weighted, those seven stocks make up 30% of the value of this chart as a surrogate for the S&P. So it skews. We know it skews, and we'll see that when we look and see what's going on in the sectors in June. The problem with that is, of course, that those stocks have been doing pretty well, and that doesn't give us a lot of information when you see an index that looks like this. And it's one of the failings of an index like the S&P 500. If you use the equal weighting S&P index, which doesn't include that capitalization, it's different. What we see in that case is that the weighted S&P 500, for example, in 2025, significantly outperformed the unweighted S&P 500. And I think, comparison would be about 18% gain last year on the regular S&P. Unweighted was maybe 10 or 11%. So it's a big difference. If you took out, just looked at all the stocks that weren't the Magnificent Seven, the S&P only gained about 6% last year. So you get an idea of what's, how significant this is, and structurally, this has got to be something that, all investors and traders need to be aware of when we see this in the marketplace. That heavy skew is probably not a great, it gives a false indication of how things are really doing. And we'll see that when we're going to look inside the breadth data within the market itself. So we know we got a sell signal back here. That was pretty good. We could have, made some, if we decided to short the market, for example, and used a ticker like SP, excuse me, whoops, let's click that, escape SPXS, for example. Direction was daily large cap bear 3 times, right? If you'd taken advantage of those sell signals that were back here, it would have been here. You could have bought in at, around about 25.77 and rode this up towards 29 area. I mean, that's pretty good, right? I mean, that's more than 10%. That's a great move within a few days. Again, you have to be nimble with these 3 times leveraged ETFs like SPXS. They're great tools at the right time, but given that they're 3 times leveraged, this thing fell apart within 2 days, right? So you got to be nimble, be in and out, probably watching that one real time. So that's where it is in the broadness of the market itself. I'll just bring up the Nasdaq just for grins. Pretty much it's looking, as we would expect, very similar to the spider itself. Let me just get rid of these two. This is what really makes it interesting. I mean, over the years, you're watching the Nasdaq and the S&P 500, right? You often got divergences because the Nasdaq was tech heavy and the S&P was more mainstream businesses. And now look at it. I mean, doesn't the spider look just like the Nasdaq? I mean, so there's some structural issues here as far as using these indexes on their own. So let's go look at internals. 7 sectors in the S&P 500. We take the S&P 500 sectors and use surrogates for each of them. In this case, I use the State Street surrogates, and they are 11 ETFs that are liquid enough for us to trade. These ETFs, for example, the one up on the screen here, XLC, is the S&P Communications sector represented by an ETF that you can trade. To gain more insight, rather than just looking at this chart with regular volume and price technical indicators, we built, 6 months ago, we built a breadth analysis tool. something we can do in our platform, which is I can pair this index, this ETF surrogate of the S&P communications sector, with all the stocks that are in the S&P 500 communications sector. And I can say, hey, give me the breadth data on just the stocks in this sector, and let's marry it to this ETF. So I've got a tradable instrument, but I also get insight to the internal mechanics of each sector. Now we look, so just keep in mind how the spider and the Nasdaq look when you go through. This is all 11 segments that make up the S&P 500, and you get an idea of how the internal market does not look like the S&P 500 at all. So first one here, what I'm going to do is pop on the indicators that give me the breadth. So I have on here the AD index and the high and low. We'll just use these. There are more, many more. I just don't want to overdo it. I'm using the two main things that we gather by using breadth data from the stocks within this sector, and that is how many are advancing, declining, and their appropriate volume, and what the new highs, new lows are. 52-week new high and new lows. How many stocks are meeting that criteria. Both of those tools give insight that we don't get from anywhere else. So we've got a market here, S&P 500 communications. I mean, you can see clearly here, this is in diametrically opposite to what's going on with the spider itself, or the Nasdaq. I mean, this is severely down. You could say it's bottoming out down here. There might be an opportunity for a bounce off of there. What's to be aware of is that the stocks making new highs versus new lows are way down. This stuff is making new lows all over the place. And here, the advanced decline index, it's kind of moving a little bit in the opposite direction overall, which is, a positive sign that this might bounce off of this area. So that's one area that there's a possibility. And again, this is bottom feeding. I will look at the expert system because this uses our market timing expert system, but I doubt we'll see a lot of clarity on this one at the moment. It's still probably in a sell signal from back there, and it is a 95 down. And if I move back, there's likely to have been a buy signal somewhere back there. Yes. So there was a sell signal up here, and there was a buy signal in here, which, again, if we use price phase, we use our phase as our indicator of choice for confirming expert ratings. I've added it in here. So that 100 up in June the 15th, which was right here, the price phase indicator is actually going down the next few days. It didn't turn up at all. Double check that. Yeah. Minus 183, minus 187. Yeah. No, actually, it did turn up a little bit. Not a good signal, that one. But the next one was, there's a sell signal here. The phase has turned down. So that's a little bit, the expert system is counter trend. You could pay that for a few days. So watch out for a bounce off there, but this could continue down. So either way, it's not looking great for longs at the moment. If I move into the next consumer discretionary, XLY is the ETF we use for this one. Again, we got like a mini triple bottom coming into place here. The great thing on this one is new highs and new lows are like on a slope up. That's a positive sign. Overall, the advanced decline indicator is kind of flat. There's no real big divergence there. We'll see if there's an expert rating on this one too. There was a sell signal right there. Phase did change down, so that's not a positive sign on that one either. I think there was an earlier signals back here too. Yeah, there was a down signal back there as well, and there was a buy signal there. So there's been some pretty short-term buy and sell signals. You have to be pretty nimble to trade that for a couple of days. But again, I mean, the overall pattern in here is pretty much trading range, right? I mean, we're stuck in this range here and in this zone here. If it breaks out to the downside, that's the next level of interest. If it breaks to the upside, there's not a lot of room up here. So I remember, again, thinking about how the SPY, you could just trade the SPY, right, on its own. But again, it's basically you're trading the Magnificent Seven when you're trading that at the moment. That's two sectors down, right? Neither of those looks anything like the spider. Into energy, right? I mean, of course, energy is a big sector. Similar type of thing going on here. This seems to have broken down below this level here, just fractionally. Once everything here, AD indicator is kind of moving in sync to the downside as the new highs and new lows. Not a lot in there to say that that's going to bounce off of there, and that's just another sell signal right there, 496, pretty good signal. Again, we're looking at a situation here where there's been no signal since then. That was a pretty good signal. Phase, did the phase change down? We need to go back here. Yeah, it did. It went up and went back down. So it's a very small phase change again. You're looking at, again, this is somewhere that's to the short side. You'd have to find an ETF if you want to trade the sector that's an inverse to this, and there are those out there. In fact, I'll probably make a list of those next time. Moving on, and I love doing this for the sectors because we have a tour to trade, we have breadth data, and we get to see what's really going on in the market. So financials here, they've been on a small rally since the end of March, nowhere near combined to what we see in the spider. Again, the ratings wise, there's most recent rating, I think was back here, was a sell signal, but phase was moving up on that one, so that wasn't confirmed. Prior signal was a sell signal back here, phase turned down. Again, you had a few days where you could have taken advantage with an inverse ETF on that one. Right now in price action, I mean, AD indicator, new high, new low, price action all moving in sync. So, you could buy into that trend, I would guess, but, the only thing to be aware of that there was a sell signal back there. It didn't work out. There's been no signal since, and there's a little room to the upside here, not a lot. But so the financials, again, not a lot going on in that area. I mean, it just considers like this healthcare. I mean, look at this. It's the triple topping area over here. Bounce back down, same sort of triple bottom back here. This has been sort of moving up in a very sort of easy sort of wave pattern to the upside. A little bit of gap here, a little bit of gap there. Again, on this one, you've got new highs and new lows are moving up. The advanced decline indicator is somewhat in sync with the price action too. And so it's not a bad group for momentum, but it did have a sell signal right here. 100 to the downside, that was confirmed because price phase turned down to the day before. But again, only a couple of days move to the downside to take advantage of that. Again, not a great group to look at. So, I mean, how many groups are we into already? So sectors, I mean, it's one, two, three, four, five sectors in. Remember, we're looking at the sectors of the S&P 500. This is what's really going on inside the market. So, industrials, so there's no breakout to the upside here, new highs. So that kind of reflects somewhat, what's happened with the Dow. It's kind of broken the new highs. That's again the same sort of thing here. This breakout here has had a bit of a pullback as well. I'm not too happy about the look of that one at the moment because AD indicator, new high, new lows was kind of moving on nicely in sync. I imagine there might be a signal on this one here. Yeah, 100 to the downside. This price phase is changed down, so that's a confirmed sell signal. So, oh yeah, I think that seems to have moved down a little bit. So that confirmed sell signal was right here. There was a second one that's 199 too. Let's keep going on. So move to the downside, possibly an inverse ETF. But again, this is one of those where you look at this and go, well, this has just been moving sideways. Next one up, we'll go into the real estate. A lot of REITs in here, progressively higher highs, excluding the big fallback in the end of March. Was an expanding range here until we got to this point here in June 22nd, where it sort of started a whole new pattern. In this case, we're looking at, this is the next high area. We could head up to that level. Looking at the expert rating, there was a 96 sell there. Last one was a buy back there. The 96 sell, let's look at phase. It was confirmed by phase. So again, you only got a couple of days. It turned around. I mean, what's it doing now? Well, we'll have to see. So again, that's, it's on a sell signal. I'd be skipping past that. I prefer just to do longs. It's so difficult to trade shorts these days because the volatility on the short side is so, it moves so fast. Again, look, I mean, this consumer staples, we're in a range here too. I mean, this is a range bound area. Might break through that area up there. The AD indicators moving in sync. The new highs and new lows are kind of in sync too. Looking at an expert rating on this one, I think there was a 0-100 there again, just like we had on the other sector. And that was confirmed. No signal since that time. Yeah, it's steer clear on this one. And next up is here's the technology. So here's the one that's the closest to the S&P, of course. It's the technology sector, which contains a whole bunch of stocks, so not just the Magnificent Seven. So what's interesting is that it's similar. It's not as precipitous a rise as you got on the Spider, but it's still pretty good. It looks like a 45-degree run up here. The sell-off and then the bounce back, and now we're back down at this level here. So what did the internals tell us about this one? Let's move this over to the left, right-hand side of the chart. I'm going to click the button. It'll take me back from the only last rating was part of a series of ratings that were to the upside. There's been no sell on this particular sector because I know there was a buy. I'm not surprising. These are all buys, right? Everything in this rally has been, phenomenal. I mean, really phenomenal for this sector. Again, right now is what we're interested in. There's been no sell signal. We are definitely in a sort of a triangle range that's beginning to form here. So will this break out? We don't know one way or another. Key thing to bear in mind here is that the new highs and new lows here, they fell in sync with the price action here. And guess what? They've continued to fall. So there is some weakness within this sector still. And the AD line, yeah, came back a little bit, but it's kind of, I mean, look at the level of the AD indicator here. It's almost all the way back down to here versus where it was at the peak here. There were some signs that this was peaking out, by the way. When you look at the AD, remember, this is the advanced decline indicator on the stocks only in this sector. And while it came up to this peak here, things were fairly in sync. This was moving in sync with the price action. Once we got to about here, let's just move this cursor to here. This one, yeah, there was a little bit of a sort of a pause there. And then this was still moving kind of in sync. But then after this pause here, we never really got back to the AD indicator being in sync with the price action. So the peaks have been getting lower and lower, whereas it's just been getting higher and higher. So there was definitely signs of weakness on the internals already, although the new high, new low was still kind of playing its game and keeping moving along. So this sector, look for a breakout somewhere along the line, either to the up or the downside on this. There's no rating to give me more on this, but that's cautionary to the downside, or cautionary that we might get to a point where there's exhaustion at some point down here, like it was down here when this was really, really low. The new highs and new lows in this sector, there's a lot of stocks in here, with a really low level down here before this rally came around. So bear that in mind. This might go back down here before we get a switcheroo. The last one I'm going to look up in here, which is the one I like actually, utilities looks of, again, we've had this triple topping area, but just again, only that technology sector looks anything like what the overall market does. I'm not going to hammer that again, but we're looking for other candidates in here. This one's not bad. You look at the way the AD indicator is moving in sync, the new highs and new lows have kind of rolled over a little bit. There is an expert rating a buy signal right here, which is good. Confirmed by phase, was turning down, has now turned up. That's good too. So this area has got a little bit of room, early June, still got room to get to the upside up here. Again, we don't know what's going to happen next, utilities, but there's room to the upside a little bit at least. So overall, from my point of view is, I'll just look at these again. I mean, look, none of this looks anything like what the S&P does. And when I look at the technology sector, what I'm going to do is just overlay the spider on this. I'm going to take these indicators off, and you'll see exactly what I mean. So when I chart ticker, and we put the SPY on top of it as a, no, I don't want to do a comparison. Let's do an overlay. Chart, overlay, SPY. You can see exactly what I mean. I mean, look how closely these two are in sync with each other. The spider versus the S&P technology index represented by the State Street XLK ETF. I mean, it's, so that's just, that's my take on this is that, yeah, there is some of the measurements that we use are somewhat broken as far as indexes are concerned. So Got to keep a close eye on what's going on internally. If you want to trade the Magnificent Seven, well, you might as well buy the Spider. And yeah, the Spider, we've had some good, uh, some good internal ratings on this too. I mean, it's not been perfect, but the sell signal there, the 100 up signal there, they're not bad ratings. They're really not. I mean, you can play some of that and playing the Spider itself. We know there was lots of SPY signals all the way up here. Over here, when we were back in February, there probably wasn't a lot going on. There was just another buy signal, buy signal. Most of these, when you look at the phase, look where the phase was on the signals here when it was going down. The phase is just going down. I mean, there's just not a lot going on to indicate what, we're getting a lot of information just using the expert system on the stock. So my next thing is, I think I'll take the Spider and make breadth data out of the S&P 500 stocks so that we get some more internal mechanics on this to get a better rating on that. So we'll get into that with another session. The final part I want to talk about today is exploring ways to try and get on the stocks that are kind of leading rallies out of these areas like this. I mean, there's obviously some of the technology stocks bounce that back out. This area here, what's the best thing to trade coming out of here if you want to get stocks and you don't like the hugely expensive, the Magnificent Seven, then there are methods of trying to get into great stocks within a great spider like this. Well, we're in the S&P 500. And we can do that by building ourselves a expert design studio file and having it actually explore momentum, really. And so what I did was I built a file with help from our friends, the AI, who are very good at building stuff and explaining it too. Once I've given it, it's got parameters. I'm not going to talk about how I've trained Claude and how it has a skill set that's based upon our coding language. It takes a little bit of time to get it to understand all of the idiosyncrasies and the complex technology that's in there. But one of the things I like about the way it structures it is it does great descriptions. It's a little tech heavy sometimes when I say that. It gets to the stage where it creates strategies that are just far too constrained and you never get any stocks. So what we did here is create something called leaders versus passengers. I'm not really interested in the passengers. Those are the ones that are kind of drag along and don't move up when the spider's moving up. What we're looking at here is let's create a strategy that when the market just turns around, let's see which stocks are charging ahead of the market itself. And we'll do this by measuring every stock against its moving averages. And what we want is trend stacked up. And this means that moving averages are stacked bullishly. So the 10 days greater than the 21, greater than the 50, and the price is holding above the 50-day. So that's a posturing as far as a leadership stock. So we're looking for that price trend up in that situation. I like that stacking of the averages. It's not just price above those averages, and it's not crossover. Well, it is crossover. It's crossed over at some point, but they're just stacked above each other in that form there. So the 10-day is kind of a accelerating momentum because it's above the 21, and then same with the 21 above the 50. Very nice little filter right there. So again, we're looking for that, that switch around when it happens. When the market just starts moving up, we try to get on the coattails of the stocks that are leading it. Now, it doesn't matter if it's tech stocks or not. I mean, we're just going to run it against the entire S&P 500. A second component is how do we make it beat the SPY, our surrogate? And we do that by just using a percentage above the value of the index itself, or the SPY in this case. And I won't go into all the details here, but it's a demand it's a demand really. If RS rising and if the RS line is greater than it was 10 days ago. So, and that RS is relative to the SPY. And that's all built in here using our ticker UDF function here. I won't go into it. It just means that it's outperforming, in this case, 3% relative strength above what the SPY is doing. So those are great measurements, something that's moving up and is beating. So moving up, beating the S&P 500 surrogate index. Volume conviction, I don't have to use this. You can use this if you expand your database into a more lower price stocks. You want a volume conviction. Basically, you want liquidity. I don't use that, but it's in here. You'd have to add it into the rule at the end if you needed to do it beyond the S&P 500. We know the S&P 500 has good liquidity overall. MACD momentum confirmation, the final stage, the classic 12, 26, and 9 MACD. And really, this is more than just, it's above the signal line and expanding. So it's more than just the crossover. It's more than just the differential line turning up. It's got a lot of things going on here. So it's a later move than would be just, say, changing of the differential line from moving down to moving up. And it's better, and it's later than, or it can be later than just the crossover. So there you have those basic screens, and put all three together, you get this sort of master rally. I put in columns just for the group and sector. Don't have the sector in there just now, just have the group in there, just to give us an idea. And what I'm going to do is just going to look back at the chart. We'll run it for, first off, back here. I just want to run it in April before we run it for the June period here. So when we go back to this date in April here, for example, this is the beginning. Price action has been moving down steadily, and then we've got this momentum kickoff right here. So it's a good day, to look for what's leading these stocks up. So if I run this for 4/6 of this year, so we'll change the date up here to 4/06. And let's run all of them. Let's see what we get. So this is the look. See if we get any stocks that actually fire during that period. We don't know for sure. This is the sort of scan where it's looking for the momentum change at that time. 4/6/2026. One stock has turned up. Two. So this is great. I mean, look, we got two stocks. We saw the bounce off of the bottom there. We know there's a possibility of something happening. And there are two stocks here, Seagate Technology, not surprising, and we have Verizon there. So let's have a look at these two stocks. I'll just chart both of them because it's rather than build a list of them. And let's see what's going on. Remember, this was on 4/6. So here we have, we'll change the date back on through Seagate first. So here we have, this is the launch off point right here. So we identified this because of an MACD. This was the one thing, because the moving averages were stacked, and because relative to the S&P 500 at the time, the SPY, this was looking far better. I mean, yeah, it's a runaway actually. I mean, it was a runaway. So what happened from there? I think we all know this thing rose anyway. Technology drove this higher. Same thing if we go look at what's happening in Verizon here. So on 4/6, the momentum is very, very strong. Think about this versus what we just saw with the S&P 500 was just coming out. These are the leaders, was leading that move from that bottoming area. And again, Verizon, of course, it's taken off pretty strongly. So you can see quite clearly what this scan does and what it looks for. So if we run back in here and pick another date, for example, so I'm going to bring up the SPY, and I won't replace it because I want to put this by the side of these charts just to illustrate, what we're looking at here. So when we had the spider here, and the date was 04/06/26, let me get rid of the MACD on this chart for a moment. So we ran this scan because we think we've come out of the bottom here. Momentum has definitely changed up, and we've had 1, 2, 3, 4 out of the past 5 days moving up after this huge move down. And guess what? Look at these charts in comparison to the spider. These were the guys that were leading the charge out. So that's what we're looking for. We're looking for charts that lead the charge out of these areas. So when we look at the more current charting area, when we look at so we were looking, spider. Let me pop this up to full screen a moment. Let's go to all the way over here. if we were looking for, right here, there's not a lot of conviction here. When it bounces out of here, you could have said this was, the start of a rally out of here. You probably could have run this scan on the same day that we had this huge switch around, big 900 Dow down, and then 8 or 900 reverse to the upside. So if you ran it on 610 on the buy day here, we'll run it on 610 and see what we get. And it's off to the races. So here you go. These are the stocks and the groups that they're in. Remember, we looked at all these sectors earlier. Not a lot going on, but there's always going to be some leaders. These stocks were outperforming the SPY at 610, even though on that big rally day. So you've got a list of stocks here. Well, we'll check out a couple of these just to give you an idea. So let's see, soft drinks. I mean, KDP, I have no idea. Yeah, moved up a little bit, had a bit of a pullback here, but still looking pretty good. Remember, this is ahead of the SPY curve because it's outperforming it on relative strength. It's also outperforming it on, it's got moving averages stacked up. It's got the MACD that's already done its crossover, as we can see back here, and the momentum is rising. That's what made this appear. So good looking stock. So that's leading the rally out of that correction area. Let's look at one more and then we'll probably be done for today. This one wasn't so good. Doesn't seem to have performed quite as well. Probably missed some of the move on that. Which again, can't win them all. And we'll have a look, see what else we have here. Well, that's a residential REIT. That group wasn't doing great. I wonder what's done since then. No, again, a couple of days, but not a great signal on that one. Again, we need to probably refine this a little better. Right now, we're looking at, you get some indications, but it looks like you might have missed the move a little bit. But again, the stocks, this one's continually rising. It's not a bad looking candidate overall, but would you have survived this pullback here? Good question. So we'll refine this a little bit more, work on maybe getting some more of the sector work in there so that we can eliminate some of these some of the stocks that don't perform so well. Telecom REIT here, again, same sort of thing. Looks to me like it is a little late. The momentum was here on that date, but it's fallen off since then. And we saw the sectors are looking a little ragged around the edges. They really are. That's it for this session, and talk to you again soon, probably in a couple of weeks. Drop me a note if you have any questions. Talk to you soon.